Okay. All right. Thank you so much, Mr. John. I want to say hello to everyone. It's nice to be here again to give a talk on the new tax regime uh, that we have now. I know that there are a lot of discussions that have been ongoing on the Nigerian Tax Act, Nigerian Tax Administration Act. There have been a lot of questions, a lot of anxiety, doubt. People are saying all manner of things. And news are flying around, and people don't even seem to know what is true, from what is not true. Because when rumors spread, it creates a lot of fear, in the heart of people. People are not aware of what is right and what is wrong. And that I know has facilitated sessions like this so that we are able to clarify um, truth from falsehood, right? Myths, realities from myths, right? So today I would be giving a talk briefly on the new tax regime and how it applies to Nigerians abroad, Nigerians living in diaspora, and we'll be, busting some myths and we'll be seeing some of the realities um, with respect to the Nigerian Tax Act. We'll be delving into things that are actually true and we'll be showing, revealing the things that are not true, right? So, okay, let's go into it straight up. All right. Okay, so the learning outcomes will be to look at the Tax Reform Act, a short overview, and the objectives of the Tax Reform Act, the key changes, clarifying the myths, and then questions and answers. All right, so of course, we are aware that the four bills were signed to law by our president: the Nigerian Tax Act, the Nigerian Tax Administration Act, the Joint Revenue Board Establishments Act, and then the Nigeria Revenue Service Establishment Act of 2025. Um, then the objective of the Tax Reform Act, to consolidate existing tax laws, enhance tax compliance, expand the tax nets, increase revenue, improve um, tax equity, and modernize tax administration through digitalization. So, what are the key changes in the NTA? First of all, we want to look at the tax residency and force of attraction rule. Okay, so first of all, we need to understand what tax residency means. What do we mean by tax residency? So Section 201 of the Act defines Nigerian residency through factors like domicile and habitual mode, length of residency in Nigeria in any year of assessment. Accordingly, anybody who falls into the following categories is automatically tax resident in Nigeria. If you are domiciled in Nigeria, or you have a permanent place of domestic use in Nigeria, or you have a place of habitual mode in Nigeria, or you have significant economic or immediate family ties in Nigeria for at least 183 days in a 12-month period. So, for example, let's say you're in the UK, but your wife and your children are in Nigeria, then that means that you are tax resident in Nigeria. If you serve as a diplomat of Nigeria in another country, let's say maybe a diplomat in the UK, right? You are tax resident in Nigeria. Or if you stay at least more than 83 days within a 12-month period in Nigeria, you are tax resident in Nigeria. A non-resident, on the other hand, is someone who is not domiciled in Nigeria, has no permanent place available for his domestic use or habitual mode in Nigeria, and has no substantial economic or immediate family ties in Nigeria. Just a moment, please. Just a moment. All right. So a non-resident Nigerian who derives employment income is only liable to tax in Nigeria if it performs employment duties in Nigeria without paying tax in their country of residence. So now all what I've said applies to someone, to a Nigerian who is non-resident in Nigeria. So if you're a diasporian Nigerian, you're living in the UK or France, right? And then your employment is liable to tax in your country of residence. Your employment income or whatever income you're having will not be liable to tax again in Nigeria. We are going to see that as we go forward, right? So there is provision for unilateral tax relief or double treat tax relief so that you are not taxed twice on the same income. But we'll see that more as we go forward. Now, so a non-resident Nigerian is also someone who sojourns in Nigeria for a period or periods amounting to an aggregate of less than 183 days in a 12-month period, inclusive of annual leave or temporary period of absence and temporary period of absence, or you are not serving as a diplomat or diplomatic agent of Nigeria in another country. Now, Section 12 of the NTA provides that the income, gains, or profits of an individual who is a resident of Nigeria are deemed to accrue in Nigeria and are eligible to tax in Nigeria wherever they arise, and whether or not the income, profits, or gains have been brought into receive in Nigeria. This means that if you are deemed to be tax resident in Nigeria, even if your income was not brought into Nigeria, you are taxable in Nigeria. Even if your income were not received in Nigeria, as long as you are tax resident in Nigeria, your income is subject to tax, irrespective of where they are received. However, tax resident Nigerians can make use of unilateral or double tax treaty credits to avoid double taxation. However, investment income sourced from Nigeria, like rent, dividends, interest, royalties, are taxable in Nigeria. Now, a key thing to note is that where double taxation exists because an individual is subject to tax on the same income in another jurisdiction, there is provision for unilateral double tax treaty credits, right, to claim, to offset the tax liability. Okay. Now, what are the implications for tax resident Nigerians? Section 13, subsection 1 provides that the income, gain, or profit from an employment shall be deemed to be derived from Nigeria, where, number one, the employee is a resident of Nigeria, or the duties of the employment are only or partly performed in Nigeria, and the remuneration accruing to the employee while in Nigeria is not duly liable to tax in the employee's country of tax residence. So, for example, let's say you're Nigerian, you're living in the UK, and you are earning income from Nigeria. Let's say you are doing a remote work in Nigeria while being in the UK, and then you are being paid in Naira, but you are in the UK. So if that income is not taxable in the UK, the income will be taxable in Nigeria. I hope you understand. You are a Nigerian, you're living in the UK, you are deriving income from Nigeria. That income is not taxable in the UK. Then the income must be taxable in Nigeria. Section 2 of the 12th schedule provides that an individual who is in Nigerian employment on 1st of January in a year of assessment, or who first becomes liable to income tax in Nigeria for that year, by reason of his entry in employment during that year, shall be deemed to be resident for that year in the territory in which he has a place of principal place of residence on that day, as the case may be, on the day on which he enters upon the full duties of that employment in Nigeria, provided that if the individual is on leave from Nigerian employment on 1st of January in a year of assessment, he shall be deemed to be resident for that year by reference to his place or principal place of residence immediately before his leave began. So now this provision is attached to what we call principal place of residence. We will get to know more about principal place of residence later, right, in the session. But one key thing to note is that resident Nigerians are taxed on their worldwide income, while non-resident Nigerians are taxed only on income sourced from Nigeria. What does this mean? if you are a tax resident Nigerian and you earn income anywhere in the world, all your income, your global income, will be taxed in Nigeria, unless maybe that those part of that income has been taxed in those countries. As long as those income have not been taxed in other countries, your global income, that is all your income from anywhere in the world, will be taxed in Nigeria. But if part of that income has been taxed in other jurisdictions, you can enjoy unilateral tax treaty or maybe double tax treaty, to offset part of your tax liabilities. But if you're not a non-resident, if you're a non-resident Nigerian, that is, you are not tax resident in Nigeria, then it's only the income that you derive from Nigeria that will be placed to tax in Nigeria. Please, we need to understand that being resident in Nigeria is different from being tax resident in Nigeria. You may not be resident in Nigeria, but be tax resident in Nigeria. And that was where I had to tell you what it means to be tax resident in Nigeria. If you are not resident in Nigeria, maybe you are in the UK, but you have your assets, maybe you have a place of habitual abode in Nigeria, or you have significant economic ties in Nigeria, your wife, your children, or your husband, your children are in Nigeria, or you have assets, considerable assets in Nigeria, or you have other, ties to Nigeria, you will be tax resident in Nigeria, even though you are not physically resident in Nigeria. Please, this is very important for us to note. All right. According to Section 17, Subsection 1, the income, profits, or gains of a non-resident person accruing or derived from Nigeria are chargeable to tax in Nigeria. Now, we want to look at some things. We are going to look at income, profits, or gains, of a non-resident person. Now, first of all, gains from disposed assets. Section 17, Subsection 2 provides that gains derived by a non-resident person from disposal of chargeable assets are taxable in Nigeria, where the gains relate to, number one, a trade, business, profession, or vocation carried on by a non-resident person in Nigeria; two, an asset located in Nigeria; or three, an asset deemed to be located in Nigeria under this act. So, for example, if you have a car in Nigeria, let's say you were in Nigeria before, then you japa from Nigeria to the UK or to the US, but you have a car here in Nigeria, or you have a piece of land, and then you dispose of that car or that land, you are going to be chargeable to tax in Nigeria. Or maybe you sell off a business enterprise, or you sell off a company that you have, or maybe sell off your shares, right? It will be subject to tax in Nigeria. Or maybe you sell off even intangible property to be subject to tax in Nigeria. So this is very important for us to note. As long as that asset is located in Nigeria, or the trade or business is carried on by a non-resident person in Nigeria, or the asset is deemed to be located in Nigeria, to be subject to tax in Nigeria. All right, number two, profits from trade, business, profession, or vocation. Section 17, Subsection 3 provides that profits derived from any trade, business, profession, or vocation carried on by a non-resident person are taxable in Nigeria, where, number one, the person has a permanent establishment or significant economic presence in Nigeria to the extent that the profit is attributable to the permanent establishment or significant economic presence. We are going to see what permanent establishment or significant economic presence means later on in the session. Number two, if the payment is made by a person resident in Nigeria or a permanent establishment of a non-resident person in Nigeria in respect of services furnished from outside of Nigeria to a resident person of Nigeria or a Nigerian permanent establishment of a non-resident person, except where the payment is made to an employee of the person making the payment under a contract of employment, or by an individual or teaching an educational institution or for teaching by an educational institution, or by a foreign permanent establishment of a Nigerian resident, and the expense is borne by that permanent establishment. So what this is saying is that if you derive profit from Nigeria or from a vocation carried on by a non-resident person, where the person has a permanent establishment. What are examples of permanent establishment? Say you have an agent in Nigeria that helps you to carry on business, or you have a subcontractor in Nigeria, or you have a permanent warehouse in Nigeria, or you have a third party that you authorized to carry out business transactions for you. This creates for you a permanent establishment in Nigeria or a significant economic presence in Nigeria, as the case may be, right? Or number two is saying that if payment is made by a person resident in Nigeria or a permanent establishment of a non-resident person, let's say maybe there is a company abroad, or maybe you are not tax resident in Nigeria, but you have a permanent establishment. I know I said that a permanent establishment can be like maybe an authorized agent or a subcontractor, or maybe you have a permanent warehouse in Nigeria, or any other thing that creates for you a permanent establishment or significant economic presence. If you derive profit from those things, those profits will be subject to tax in Nigeria. So say, for example, now you have a company, firm, supermarket, or any other business enterprise in Nigeria where you do business and earn profit, and the business activity is targeted mainly to Nigerians, you will be liable to pay tax in Nigeria. This is very important for us to note. Okay. Number three, profits from trade, business, vocation. Okay. Okay, so this is still an extension of the previous slide, right? If payment is made to that person by a person resident in Nigeria or a Nigerian permanent establishment of a non-resident person, in respect of insurance premiums or risks insured from the territory of Nigeria, right? So non-resident Nigerians are not taxed on their foreign employment income as long as it is not sourced or received in Nigeria. Accordingly, non-tax resident Nigerians will be taxed on income sourced from Nigeria, brought into or received in Nigeria. So if you are not tax resident in Nigeria, but you bring your income, your profit into Nigeria, you receive it in Nigeria, it will be subject to tax. So Nigerians with global income or dual residency must carefully manage cross-border tax exposure and documentation. So if you have dual residency or you have global income, maybe you have income from like maybe 2, 3, 4, 5 countries, right? You must carefully manage your cross-border tax exposure and documentation to ensure that you are not taxed in multiple places. Okay, now the previous slides we looked at, we're talking about tax resident individuals. Now we want to look at tax resident companies. Now, tax resident companies now include foreign incorporated companies that are centrally and or effectively managed or controlled from within Nigeria. They will now be subject to tax in Nigeria on their global income. Now, the definition of a Nigerian company previously was a company that was just registered or incorporated in Nigeria. That was what a Nigerian company was. But now the NTA has expanded the definition of a Nigerian company. So now a Nigerian company does not just mean a company that is formed, registered, or incorporated under any law in Nigeria. It also means a company whose central place of management or control is in Nigeria, or whose effective place of management or control is in Nigeria. So if, for example, you have a company or a business in the UK, but the place of control or place of management is in Abuja or in Lagos, your company is a Nigerian company, even though it is physically situated in the UK. So for example, now, if you have a family business that's abroad, but the people managing the company, the people making decisions or the major stakeholders are in Lagos, they're in Ikoyi. That company, that family business is a Nigerian company. I hope you understand. This is important. All right. Although the Act provides for unilateral tax relief on foreign source income that is also taxed in Nigeria, offering some respect, but it's important for us to know that the um, definition of a Nigerian company has now been expanded. Okay. I need to rush. Section 12 of the 12th schedule of the Act defines a place of residence in relation to an individual as a place available for his domestic use in Nigeria on a relevant day and does not include any hotel, rest house, or other place at which he is temporarily lodging unless no permanent place is available for his use on that day. So it defines principal place of residence as place in relation to an individual with two or more places of residence on a relevant day, not being both within any territory, as in the case of an individual, as with no source of income other than a pension in Nigeria, the place where he usually resides, or the place where on a relevant day is nearest to his usual place of work, or the place for someone who has a source of income of unearned income in Nigeria, the place where he usually resides, or for someone who works in a branch office or operational site of a company or other body corporate, the place at which the branch office or operational site is situated. Provided that that operational site shall include oil terminals and the rest, right? So if you have two places of residence, right, your principal place of residence will be a place where you usually reside. If you don't have any other source of income other than a pension in Nigeria, or the place that is closest to your place of work, if you have a source of earned income other than a pension in Nigeria, or the place where you usually reside, or the place at which your branch office or operational site is situated, right? So now, Section 4 of the 12th schedule defines the principal place of residence in relation to an individual who is a partner in Nigeria as the place where the individual is engaged in the performance or exercise of his duty of partnership, or if the person is a dormant partner in the partnership, the territory in Nigeria where he usually resides, or if the person is a dormant partner that does not reside in the territory in Nigeria, the place where the person is deemed to be a person to whom Section 3, subsection 1A4 of the Act refers. Then Section 17 subsection 9 introduces the concept of force of attraction, which allows for certain activities carried out by a non-resident company or its related parties to be taxed as part of the non-resident company's permanent establishment in Nigeria, even if those activities are not physically conducted to the permanent establishment. That is, if an NLC has a PE, a permanent establishment can be a fixed base, an authorized agent, or a subcontractor in Nigeria, but is making profits from abroad, maybe by providing services, from abroad under a separate contract. The global profits of that company shall be taxed as part of its profits of its permanent establishment in Nigeria, even if those activities are not done by its permanent establishment. So what this means is that you are a company in the UK, but you have a permanent establishment in Nigeria. The profit that your company makes, the global profit, shall be taxed in Nigeria, even if those business activities were not carried out by your fixed base authorized agent or subcontractor that is in Nigeria. According to Section 17, subsection 8, the global profits of NRCs that have Ps or SCPs will be subject to the higher of the minimum tax based on the percentage of their earnings before interest and tax to total income generated from Nigeria, or their tax payable that is not less than the total tax rate applicable to the income, or 4% of the total income from Nigeria if it's not liable to the total tax. So the highest of these three, right, will be their tax rate. Now, this means that NRCs must submit tax returns in Nigeria for the entire EPC services. For those that that do engineering, procurement, or construction, the NRCs must submit tax returns in Nigeria. So if you have a company in the UK that is engaged in engineering, procurement, or construction in Nigeria, you have to submit tax returns in Nigeria. Now, a permanent establishment will not apply where an NRC employs a Nigerian resident whose activities are performed primarily for non-Nigerian customers. Say, for example, you have a company in the UK and you have a fixed base or a subcontractor or authorized agent in Nigeria, but the goods or services of that fixed base in Nigeria is not directed to Nigerian customers. Let's say that it is exported service or exported goods. It will not create a permanent establishment in Nigeria only because those services or goods are not primarily targeted to Nigerian customers. They are exported. Now, we look at the concept of significant economic presence. A non-resident person shall, subject to any regulations that will be issued by the minister to that effect, have a significant economic presence in Nigeria where the person transmits, emits, or sends by itself or through other persons signals, sounds, messages, images, or data of any kind by cable, radio, electromagnetic systems, or any other electronic or wireless apparatus in Nigeria in respect of any activity through electronic commerce and the likes. In other words, SCPs focus on digital activities. It applies to NRCs that remotely carry out digital activities targeted at, customers in Nigeria. Previously, only companies that, that engage in TMPC services, technical professional management or consulting services, were, um, uh, were considered to, create an SCP. But what it means is now is that only companies providing digital services targeted at Nigerians are the ones creating SCPs. Companies that do TMP services no longer create SCPs. So previously, before the NTA, it was companies that do TMP services, NRCs that do TMP services that create SCPs in Nigeria. But now, only companies that provide digital services create SCPs. Companies that do TMP services no longer create SCPs in Nigeria, right? So NRCs that receive payments from a Nigerian resident or Nigerian P of a non-resident for the provision of remote services are taxable in Nigeria. The tax withheld on these payments will be the final tax for that NRC. Concept of minimum effective tax rates. So what this means is that companies who generate annual revenue of 50 billion and above, or Nigerian company that is a constituent entity of a multinational enterprise, with aggregate group turnover of at least 750 million, will be subject to ETR of 15% of their profits. Profit is defined. Someone saying something? Profit is defined as net profits before tax, as reported in their audited financial statement, less 5% of depreciation and personnel cost for the year. An effective tax rate means the rate produced by dividing the aggregate covered tax, for that year of assessment by the profits of the company. So the minimum ETR is required to be computed by dividing the aggregate covered tax, paid by the company for that year of assessment. Now, covered tax means the total income tax paid in any year of assessment. Now, let's quickly look at some common myths that are being peddled around, and let's see what are the realities. So now, common myths and facts. Number one, income earned and received abroad but brought into Nigeria by a non-resident is taxable in Nigeria. The fact is, foreign employment or business income earned abroad and remitted to Nigeria by Nigerians in diaspora is tax exempt from Nigerian tax as long as the individual is non-resident under the 183-day rule. So if your income is brought into Nigeria, if you're not resident but your income is brought into Nigeria, your income is not automatically taxable in Nigeria as long as you've not spent 183 aggregate days in Nigeria. Myth number two, every transfer of money from Nigerians abroad to their family back home will be subject to tax. This is not true. If you are in UK and you are sending money to your parents at home, you are sending money to your wife or to your children or your siblings, the money will not be subject to tax. Or maybe you are sending money to them to help you maybe build a house or whatever. That income will not be subject to tax. I mean, that money, that transfer will not be subject to tax, right? Unless it's an income that is earned or deemed as earned, that will be taxed. It's only income that is earned or deemed as earned from Nigeria that will be taxed. And examples of those income include wages, salaries, business profits, or investment returns. Right? Number three, Nigerians abroad will pay tax on their foreign earned salaries and their business income, both abroad and at home. No. The NTA does not look to charging you tax twice on your income. So if you are earning income in the UK and you've paid tax on that income in UK, even if you are tax resident in Nigeria, you will not pay tax on that income again because you will be able to enjoy unilateral tax treaties or double tax treaties. So non-resident Nigerians are taxed only on income derived from Nigeria, such as rental income, dividends, or business profits. So if you are in the UK and maybe you have a house here that you put in as rent, you have an apartment or a house in Nigeria that you rent out to people in Nigeria, right? The income you are getting from that will be subject to tax, right? But if you are earning income from UK and that income has been taxed in the UK, even if you are tax resident in Nigeria, that income will not suffer another tax in Nigeria because you'll be able to enjoy unilateral tax treaties or double tax treaties, as the case may be. Number four, holding a Nigerian passport automatically translates to taxable presence in Nigeria. Taxable presence is determined by tax residency, not by citizenship or passport. So what determines whether you are taxable in Nigeria is if you're tax resident in Nigeria. Number five, all Nigerians abroad must register with FIRS or obtain a TIN and file tax returns in Nigeria. This is not true. Nigerians abroad are not required to register with FIRS or obtain a TIN or file tax returns unless they earn employment or business income in Nigeria. So only people who earn income, wages, salaries, profits, or investment returns are going to file and pay tax in Nigeria. Myth number six, the NTA intends to use Nigerians abroad to raise tax revenue. No. The objectives of the NTA are to consolidate existing tax laws, enhance tax compliance, improve tax equity, modernize tax administration through digitalization, among others. It is not to use Nigerians abroad to raise tax revenue. Myth number seven, 18 is required to open or maintain bank accounts. You are not required to use a TIN to open or maintain a bank account unless you intend to use that account for business purposes or for income receipts from businesses in Nigeria. Myth number eight, when a Nigerian living abroad opens a bank account in Nigeria, he or she automatically creates a taxable presence in Nigeria. No. Having a bank account in Nigeria does not translate to taxable presence in Nigeria. What makes you have a taxable presence in Nigeria is if you are tax resident in Nigeria or you have a permanent establishment or significant economic presence in Nigeria. And lastly, myth number nine, all Nigerians in diaspora working remotely for foreign employers, either in a foreign country where they are residents or for foreign employers in other country, will not be taxed in Nigeria. This is not true. salaries or wages from remote employment becomes taxable in Nigeria only when the Nigerian has a taxable presence in Nigeria, and taxable presence is determined by residency, business or economic activity, or income derivation from Nigeria. So that's all for my session. So if you have questions, this is a good time to ask your questions. So probably I'll take just 5 questions because of time.
Yeah, thank you,
Yeah,
Mark Ronald. That was a very enlightening session. I want to trust that the people have a lot of questions to ask. Um, you can either put the questions in the chat box, or if you are, if you're very bold enough to ask a question directly, yes, I think the floor should be open for questions. Thank you very much for that presentation, Mark Ronald.
I
Right,
have a
let's see
question, though, please. I have a question.
Who is talking now?
My name is Andrew Tafame.
Oh, yeah, Prof. Go ahead, please.
Yeah, thank you very much for that presentation, McDonald. Well, I have 2 questions. First, I teach remotely from UK to 2 universities in Nigeria.
Neighbor has washed the floor.
Can you hear me?
Yeah, I can hear you. I think
Okay,
there's a noise in the
I teach from here 2 universities in Nigeria. What percentage, if they are going to remove the tax, what percentage of tax are they going to remove from the money I'm going to be paid? That is one. My second question is, I did some investment with Bamboo. I just got an email some days ago that withholding tax, based on the directive of the Nigerian tax law, they're going to be removing 30% from the withholding from my asset or something like that. I just need a little clarification on that, please.
Okay, so for the first question, you will be taxed in Nigeria if so we have a progressive tax band, right? So I have a progressive tax band based on the amount of your income, starting from 0% all to 25%. So it's a progressive tax band. So people are earning below 800,000 in a year will not be taxed. But people are earning above that to be taxed progressively, from 0 to 25%. So I don't have all the because it's in cadence, it's a progressive band. So from 0 to 8%, 15% like that to 25%. So I don't have that yet, but you'll be taxed progressively. It's a progressive band. And then for your second question about investment, your investment should be, I think the rate at which you are going to be subject to tax should be a higher of withholding tax on that investment. So withholding tax should be, if it's a contract of service or a contract of supply, should be 2%. Or maybe, so it's either higher of 2%, which is withholding tax on contract of supply or service, or 4%. So we have, just a moment, sorry. So the withholding tax there should be 2%, especially because I think it's a contract of, it's going to be like maybe a contract of service. You have a contract agreement with them. They are going to charge you 2%, on that your investment on the Bamboo. Can I know kind of investment it is? Which kind of investment it is? What do you invest in?
All those what's called Dangote, Seplat, Okomo Oye, and others.
Okay, so like you bought shares then.
I bought
And then
shares,
you are
yes. Yeah.
Oh, okay. So for dividend is 10%.
Okay.
What about sale of shares as well?
No.
Thank you very much.
Sale of shares, yeah, welcome. Sale of shares would be, so that would be like CGT. That would be like CGT. So CGT is 30%.
Okay. Now,
Can I ask a question, please?
thank you so much, Mark Ronald, for your presentation. It was very elaborate. From what I see, a lot of these changes that has been made to the tax law is kind of like copying the US tax system. So my question is this. if we're going to be taxed, like people like me who sit here and just like the last caller said, I do some investments in in the stock market back home in Nigeria, and definitely I know I have to report my income globally. So that means that whether I like it or not, I need to be taxed in the US, and then Nigeria is also going to take their
Sorry,
tax.
can you start your question again? I didn't get some parts.
That's the question.